Up next on Dukascopy TV, we're talking Australian budget. The Commission of Audit said yes to a tough budget. The OECD warned of the economy's vulnerability to harsh fiscal policy, while the IMF advised that Australia had scope to delay. Rajiv Biswas, Chief Asia-Pacific Economist at IHS, is on the line now. Rajiv, a debt levy for people earning more than $180,000, greater pressure placed on students to repay university loans, and subsidies for hiring businesses. As Australia aims to nearly halve its budget deficit, what for you were the high and low notes of today's much debated announcement?
I think the current government has inherited a very difficult fiscal situation. So I think this budget was necessary. It needed to be a tough budget, and I think they've done a great deal in their plan for the financial year ahead. The deficit in the current financial year is estimated at about 50 billion Australian dollars, and for the year ahead, which the budget was now announcing the plans for, the deficit is planned to be almost halved to 28 billion Australian dollars. So that's quite a substantial step towards getting back towards a balanced budget. So I think it's a good start from the new government that they are making very substantial steps towards fiscal consolidation. But they have a very large task ahead.
Forecasts from today's budget showed that the jobs market is expected to deteriorate next financial year. Was this a surprise to you, given the progress the labour market has made of late?
What we are seeing in Australia is quite a transformation of growth drivers. In the last few years, Australia has benefited from a very large mining-related construction boom, with a lot of projects being built in the resources sector for oil and gas, and also for other major exports of commodities such as iron ore. But this mining construction boom is coming to an end because a lot of this large pipeline of projects are coming to their natural completion dates by 2016 and 2017. And the implication of that is that one of the important growth drivers for the Australian economy will be starting to taper off quite significantly over the next 2 years.
Australia's hot housing market may be starting to lose steam, as house price data released today showed growth at a slower than expected pace. Whichever way this data fell was likely to be used by advocates on either side of the budget fence. Could today's fiscal approach support more sustainable price growth for the housing market?
I think the key to what's happening in the housing market is really with monetary policy and what the Reserve Bank of Australia has been doing in terms of lowering interest rates with a number of rate cuts. And that really provided a lot of stimulus for an upturn in house prices. And basically over the last 12 months or so, the increase in residential house prices in Australia was of the order of about 11% higher. And in some particularly hotspot markets, which notably Sydney, the increase was even stronger, with an increase in the order of about 17% over the last year. And that's very, very strong, which is why there's some concern amongst analysts that property prices have been rising too rapidly and could be at risk of correction. I don't think the RBA has got much scope to cut rates further unless there's a very big change in the global economic environment. And in fact, they may be, on hold or even starting to be looking towards a rate rise, or at least have a bias towards a rate rise soon. So that means there isn't going to be a further stimulus towards, house price increases in construction or a big surge in new purchases of property. So I think there should be some stabilization coming through over the next 12 months in the property market, given this backdrop of probably relatively stable monetary policy.
The Aussie dollar was seen to be treading water ahead of the coalition's first budget, despite bearish signals. Has the path been set for a more stable devaluation for the currency?
I think in terms of the Australian dollar, we have seen some depreciation of the Australian dollar over the last 12 months against the US dollar, particularly due to concerns about softer growth in China because of the importance of China as an export market for Australia, but also because of monetary policy and the rate cuts that have happened in Australia, because Australian dollar yield has been quite an important factor driving global financial markets investors to invest in Australian dollars. The yield had been high relative to other countries such as the US or UK, which have had quantitative easing policies in place and have extremely low yields. So this reduction in the yield differential was one factor that dragged down the Australian dollar. But it has stabilized in recent months. And I think given the outlook is still for reasonable positive growth and the expectation is that there won't be more rate cuts, that we should see some continued stability in the Australian dollar, as long as there aren't big changes in the external environment. The biggest risk that the Australian dollar would face is if there were a China hard landing, and we saw a big slowdown in demand for commodities coming out of China. That sort of scenario would result in quite a big shock, I think, to the Australian dollar again. But that's a risk scenario, and it's probably not that likely to happen at the moment. So there are downside risks to the Australian dollar, but we see that it would probably continue at about the exchange rate it's at against the US dollar over the year ahead.
Well, that's all we've got time for right now, but Rajiv, many thanks for your insight. It's goodbye from me.